VIP John AG here. Silver just crashed below $32, and I need you to understand something critical right now. This is not just another dip. This is not just another buying opportunity headline. What happened in the last 72 hours represents a coordinated assault on precious metals that erased billions in value while the mainstream financial media cheered it on. Gold dropped over $100 in a single session. Silver got absolutely hammered, falling from $34 to below $32 in what can only be described as a precision strike. And here's what makes this truly disturbing. The physical market is screaming one thing, while the paper market is saying the complete opposite. By the end of this video, you're going to understand exactly what just happened, why it happened, and most importantly, what it means for your position going forward. Because the level we're sitting at right now changes everything. Let me give you the full picture of where we stand right now with actual numbers, not speculation. As of this recording, silver is trading around $31.60 on the COMEX. Gold has pulled back to approximately $3,230 per ounce after touching all-time highs above $3,500 just days ago. Now here's your first critical data point. The Shanghai Premium, which measures the difference between physical silver prices in China versus paper prices in the West, has been fluctuating wildly. When physical demand is strong in Asia, this premium expands because buyers are willing to pay above the spot price to get actual metal in their hands. What we've seen recently is that premium holding steady or even expanding during this paper price massacre. Let me say that again. While the paper price crashed, Asian buyers kept paying premium prices for physical metal. That divergence tells you everything you need to know about what's real and what's manufactured. Now let's talk about what triggered this sell-off, because the timing is not coincidental. We had a perfect storm of factors converge in a matter of days. First, the Federal Reserve signaled they're in no rush to cut rates. Fed Chair Powell made it crystal clear that with inflation still running hot and the labor market showing resilience, the Fed is comfortable keeping rates elevated. This sent the dollar index surging above 104, and when the dollar rises, commodities priced in dollars typically fall. That's the textbook explanation you'll hear on CNBC. But here's what they won't tell you. Second, we saw coordinated margin hikes at the exact moment precious metals were hitting resistance levels. The CME Group raised margins on gold futures, effectively forcing leveraged traders to either post more collateral or liquidate positions. When margin hikes hit, the weakest hands get shaken out first. And this wasn't just gold. Silver margins have been adjusted multiple times in recent months, each time at technically significant moments. Third, and this is critical, the geopolitical landscape shifted rapidly. We had optimism about potential peace talks in the Russia-Ukraine situation, which reduced some safe haven demand. We saw headlines about potential tariff negotiations that temporarily eased trade war fears. And Treasury Secretary Bessent made comments about pursuing dollar stability and trade deals with China. All of this combined to create a narrative that the world is getting safer, that risk assets are the place to be, and that gold and silver are no longer necessary hedges. But here's where the narrative falls apart when you look at the actual data. COMEX registered silver inventory has been declining for months. We're sitting at levels that should have every institutional investor paying attention. The eligible category, which represents silver that's available for delivery, has been getting drained consistently. Meanwhile, delivery notices on silver futures have remained elevated compared to historical averages. This tells us that some large players are not rolling their contracts forward. They're standing for delivery. They want the physical metal, not the paper promise. And when you zoom out and look at the total COMEX inventory picture, we're looking at roughly 300 million ounces, give or take. That sounds like a lot until you realize that annual industrial demand alone exceeds 600 million ounces globally. We're talking about less than 6 months of industrial supply sitting in COMEX vaults, and that's before any investment demand. Now let me bring in the mining supply picture, because this is where the story gets even more compelling. The Silver Institute projects a structural deficit in silver for the 4th consecutive year. We're looking at a gap between supply and demand of approximately 200 million ounces annually. The last time I checked, deficits don't get solved by crashing prices. Deficits get solved by either increasing supply or decreasing demand. Mining companies aren't ramping up production at $32 silver. The all-in sustaining cost for primary silver miners has been rising due to inflation, labor costs, and energy prices. Many primary silver miners need prices above $30 just to break even, and some need even higher. So you crash the price, you don't solve the deficit, you make it worse by discouraging investment in new production. Looking at the numbers, about 75% of you watching aren't subscribed. If this unfiltered analysis is cutting through the noise and giving you clarity, hit subscribe. That's how we grow a community built on truth, not hype. Drop VIP, John AG in the comments so I know you're part of the crew. If it's not for you, no hard feelings. I don't chase empty metrics. I don't sell signals, mentorships, or courses. This channel exists because someone needs to say what the mainstream won't. Now let's continue. Here's what makes this truly insane, and this is the part they absolutely don't want you to see. Let me connect some dots that should make the hair on the back of your neck stand up. In the weeks leading up to this crash, we saw record outflows from gold ETFs. Approximately 23 tons left GLD in just a few days. That's not retail selling. That's institutional repositioning. And where did that gold go? It didn't evaporate. Someone took the other side of that trade. Now, simultaneously, central banks globally have been accumulating gold at a record pace. China has been adding to its reserves month after month. The People's Bank of China officially reported increasing gold holdings again, and the smart money knows that official Chinese numbers likely understate their actual accumulation. Russia continues building reserves. Turkey, India, Poland, the list goes on. Central banks bought more gold in recent years than at any point since the 1960s. So, ask yourself this question. If gold is such a terrible investment, if it's just a barbarous relic as the mainstream loves to claim, why are the most sophisticated financial institutions on the planet hoarding it? The answer is obvious. They know what's coming. They know the current monetary system is approaching an inflection point. They know that debt levels are unsustainable. U.S. national debt has blown past $36 trillion. Interest payments on that debt now exceed defense spending. We're paying over $1 trillion annually just to service existing debt, and that number is growing. This is not sustainable, and everyone in positions of power knows it. And here's the smoking gun. JP Morgan's position in silver has been a topic of discussion for years in this community. The bank that got caught manipulating precious metals markets, that paid hundreds of millions in fines for spoofing, maintains one of the largest physical silver positions in the world. Their vault holdings have grown substantially over the years. They don't accumulate silver to lose money. They accumulate silver because they know where this is going. When the largest bank in America is stacking physical silver while the paper price gets crushed, that should tell you everything. This is the transfer of wealth happening in real time. Weak hands sell to strong hands. Retail investors panic while institutions accumulate. The paper price goes down while physical premiums remain elevated. It's a playbook that's been run before, and if you've been watching this channel, you already knew this was coming. Now let's talk about the divergence between physical and paper, because this is where the rubber meets the road. Right now, if you go to any major online dealer, you're going to find premiums on physical silver that tell a completely different story than the spot price suggests. American Silver Eagles are commanding premiums of $4 to $6 over spot. That's a 15 to 20% premium on a 1-ounce coin. Generic rounds and bars carry smaller premiums, but they're still elevated compared to historical norms. And here's what's really interesting. Try buying a monster box of Silver Eagles right now. Try placing a large order. You'll find that delivery times have extended. Mints have backlogs. The U.S. Mint has been rationing Silver Eagle allocation to authorized purchasers for months. Meanwhile, in Shanghai, physical silver is trading at premiums that reflect actual scarcity. The Shanghai Gold Exchange is moving real metal, and the prices there often diverge from COMEX paper prices. This premium can swing between 1% and 3% or more, depending on demand conditions. When paper prices crash and Shanghai premiums hold or expand, that's the market telling you that physical is what matters, not the paper derivative. The COMEX is a pricing mechanism, but it's increasingly disconnected from the physical reality. Less than 1% of futures contracts typically result in actual delivery. The vast majority are settled in cash or rolled forward. It's a paper casino where algorithms trade against each other, where spoofing and manipulation have been documented and prosecuted. and where the price you see on your screen may have little relation to the price you pay for actual metal. Let me address the bearish case head-on, because balance matters, and I refuse to be a one-sided hype channel. Here's the reality of the risks we face. First, margin hikes can continue. If silver attempts to rally and threatens certain price levels, exchanges have every tool available to raise margins further. This forces leveraged longs to liquidate, creating cascading selling pressure. We've seen this playbook before. Remember May 2011 when silver hit nearly $50 and then got obliterated? Multiple margin hikes in rapid succession destroyed the rally. Second, dollar strength could persist. If the Fed maintains its hawkish stance, if rate cuts get pushed further into the future, the dollar could continue grinding higher. This creates headwinds for all commodities, including silver. Third, recession risk is real. If we enter a significant economic contraction, industrial demand for silver could fall. Silver is used in solar panels, electronics, EVs, medical devices, and countless industrial applications. A recession could dent that demand substantially in the short term. Fourth, liquidation cascades can create a self-reinforcing downturn. When leveraged positions get stopped out, they create selling that triggers more stops, which creates more selling. We've seen flash crashes in silver before where the price drops 5 or 10% in minutes due to these cascading liquidations. The bears would argue that with debt levels where they are, with a potential recession looming, with the dollar strengthening, silver could easily revisit $28 or even $26. That's not fear-mongering. That's acknowledging real risk. And if you're overexposed, if you've got capital you can't afford to lose tied up in silver, you need to be aware of these scenarios. Now here's the bullish case, and I believe fundamentals ultimately win over manipulation. First, the supply-demand fundamentals haven't changed. We still have a structural deficit. Mining supply isn't increasing. Industrial demand, particularly from solar, continues to grow exponentially. The world added record solar capacity last year, and every solar panel requires significant silver. Electric vehicles use more silver than conventional cars. The green energy transition, regardless of your political views on it, is a massive silver demand driver. Second, central bank behavior tells you where this is ultimately going. They're not buying gold because they think fiat currencies are solid. They're buying because they're preparing for a monetary reset of some kind. And historically, gold and silver move together, with silver often outperforming on the upside due to its smaller market. Third, the gold-to-silver ratio remains extremely elevated. We're sitting around 100 to 1. Historically, this ratio averages closer to 50 or 60. During precious metals bull markets, it compresses significantly. If gold holds at 3,200 and the ratio normalizes to even 70 to 1, that implies silver at $45. At 50 to 1, that's silver at $64. Fourth, and this is critical, the paper manipulation cannot last forever. Eventually, physical demand overwhelms the paper games. Eventually, delivery demands drain the registered inventory. Eventually, the disconnect between paper prices and physical reality becomes so extreme that the system breaks. When that happens, price discovery moves to the physical market and paper prices become irrelevant. 3 key takeaways, and we're out. 1. This crash was orchestrated, not organic. The combination of margin hikes, ETF liquidations, coordinated selling, and narrative shift happened simultaneously at technically significant levels. The smart money is using this weakness to accumulate while retail investors panic. 2. Physical and paper have diverged, and that divergence is your signal. When dealers maintain premiums, when Shanghai pays above COMEX, when delivery times extend even as the spot price drops, the physical market is telling you the truth while the paper market lies. 3. Your response to this crash defines whether you're a speculator or an investor. Speculators panic at drawdowns. Investors recognize that nothing about the fundamental thesis has changed. Supply deficits persist. Central banks accumulate. Industrial demand grows. Mining supply stagnates. The only thing that's changed is the price. And for accumulators, lower prices are the gift, not the curse. The unresolved tension is this: can the paper market continue to suppress prices indefinitely while physical demand remains robust and supply deficits persist? Or are we approaching the point where the physical market takes control and price discovery moves away from the paper manipulation? That question will be answered in the coming months, and when it is, those who positioned correctly will be generationally rewarded while those who panicked will be left wondering what happened. Do your own due diligence. Understand the risks. This is not financial advice. Be accountable for your own decisions. I'm just a guy with a camera sharing documented data and connecting dots. You have to decide what's right for your situation, your timeline, your risk tolerance. Invest with logic, not hype. VIP out. P.